Good morning, everybody. Welcome to the Flow Show. It's Monday, and everything you've just been through has just been a dream. It's really Monday today, and we got the week ahead. Morning, Kay. How you doing, mate?
Hi, good morning, Ryan. Yeah, I was going to make the announcement that we finally made it through, but you're you're giving us already a little look ahead at what's still waiting next week. Then.
No, I was saying it was Monday just gone, and we got the week to go. But it's been another long week, and well, that's why we're here, to get through these weeks, trade as best as we can, hopefully make some pips out of it, and definitely not to lose money. So that's always the outcome. Whew. A long week. Can't wait for Christmas. Right, let's get stuck in, because obviously tons to talk about again today. More central banks going under the bridge. So I'll get through a lot of the stuff as quick as possible before we get stuck into all that lot. Start with the data. China had some data out overnight, relatively good. We had some retail sales. I can find it all. There we go. We had some retail sales out, looking positive year on year. Not as much as expected, but still a strong number. Industrial production showing up strongly as well, up 6.6%. Some investment data there coming in a little miss on expectations, but still a positive number. Unemployment staying unchanged. Year to date, retail sales, you can see they're positive as well. So a little bit of good news for China. But we know, particularly on the retail side, they are doing a lot of measures for things like electric vehicles and the like to boost domestic demand amongst the consumer. So maybe that's paying off a bit there. China's National Bureau of Statistics were out with their latest waffling, saying that they expect their full year development targets to be achieved and that China will not see deflation. Let's see what they do ahead of that one. Over in Japan, obviously PMI day as well coming through from a lot of the countries. Manufacturing taking another hit. It's been a bit of a story so far today from a lot of countries, but services picking up on the other side. So negative on the manufacturing, positive on the services. Coming through into Europe and all the PMIs. We had final CPI numbers from France, a pip up on the prior, flash and expectation there, 3.5% in CPI, or in the CPI in HICP, up again a pip over the prior number. So still a bit sticky in France. A horror show for their PMI as well. Manufacturing falling back further, was expected to rise, but it ended up lower than last month. Services as well, expected to rise, ended up lower. Same for Germany a little bit. They did get a little bit of an improvement on manufacturing, and a little bit, well, then services went backwards. So that went the other way. Italy CPI data there as well. Year on year HRCP coming down a bit. We've got 0 points in Italy rather than, compared to France, 3-4%. So Italy heading potentially for a little disinflationary, deflationary potential there. But remember, Lagarde and a lot of other bods expected inflation to pick up the latter part of the year. UK, rock and roll on the services number, 52.7, the bigger sector for the UK economy. So busting out further to the upside from the 50.9, beating expectations. Manufacturing, though, slumping further into contraction. But it's the services number that takes the biscuit in that data due to the size of the economic sector there. The Bank of Japan is going to phase out loose monetary policy in January, according to over 20% of economists polled by Reuters. So the market already starting to come around to what the Bank of Japan is going to do in the new year. Oh, I nearly forgot. We had, just quickly, we had Aussie PMIs as well as new New Zealand PMIs. So New Zealand business PMI coming in better. Manufacturing in Australia a little bit better. Services a little bit better. There you go. I don't want to forget things. We're over that one. Right, central banks. I forget. Did we have the noughties yesterday as well, or was that the day before? I really can't remember. I've lost count of all this.
Yeah. That was all yesterday, my friend.
Noughties was yesterday. Okay, tell us about noughties. No, we did all that, didn't we? We did all that in yesterday's show.
We covered that yesterday, actually, already.
Yeah, I know. Oh, see, I'm all. Kate, I'm going home. You take over.
This is. I hope the rest of the data come out relatively normal, because this is not going to be your day otherwise, mate.
No, I know, exactly. The only thing I'm thankful of is I haven't got bra adverts on the thing anymore. It's changed to, oh look, we've got Paul McCartney today. You scoundrels yesterday saw a load of bra brassiere adverts.
I missed that, right? I had to put it in the room.
Yeah, exactly. So yeah, anyway, we've got PC clean now. Right, back to the central banks we didn't talk about. Bank of England. They kept rates unchanged as expected, and they actually kept the vote unchanged at 6-3. The market was expecting a 7-2, i.e. one of the hawks jumping to the keep rates unchanged ship, but they didn't. The three hawks stayed in place. Bailey, and the statement was dovish, saying there's still some way to go in the inflation fight. Monetary policy is likely to need to be restrictive for an extended period of time, and further tightening would be required if there was evidence of more persistent inflationary pressures, and that the decision to hike or hold was finely balanced. So, as I was certainly expecting, they kept the hawkish slant in there. Bailey was out on the various media pop-ups after that, saying it's really too early to start speculating about rate cuts. We are more cautious than markets. We cannot say that interest rates have peaked, but they're encouraged by the progress, but persistence is an issue. So it's all coming up. Roses still for the pound, still hawkish sounding BOE data improving. That's going to keep a bit of a premium in the UK over the Eurozone, particularly when you're looking at currencies like Euro Sterling. Right, over to the ECB. Unless you've got any comment on the BOE, Kay, before I move on.
No, mate. I think it was one of the more stable, hawkish, well, apart from perhaps the ECB, but I have different ideas about the euro anyway. But no, I think it was, despite those weaker data that we had the days before, it was one of those who still kept everything in place, and again, sterling being helped a little bit by the PMIs this morning. Sterling still looks one of those currencies that are performing relatively well, right?
Yeah, exactly. Well, until the next cratering data point, but we shall see. We've got a few bits next week on the data front. Not that I think the market will pay much attention to them. I think CPI and retail sales next week as well, but we'll be well into holiday trading by then, but worth keeping an eye on. I still think retail sales, via my anecdotal evidence in November, could be a decent number, but whether anyone trades it is another question. Anyway, over to the ECB. They kept rates unchanged as expected. Statement said they will set interest rates at sufficiently restrictive levels. They see inflation coming down to 2.7% from 3.2% in 2024. GDP got cut as well for 2024 to 0.8% from 1%. We did get talk on the PEP and reinvestments and what they're going to do. They're going to continue reinvesting fully through the first half of 2024. Then from the second half of 2024, they're going to reduce PEP by 7.5 billion per month, and they intend to discontinue reinvestments altogether at the end of 2024. So not really anything majorly hawkish in that for the euro to grasp. They're going to slowly phase it out. There wasn't any big gang-busting moves on that, but they're moving anyway on the PEP. They also said that rates will be sufficiently restrictive for as long as necessary. Lagarde was a bit Tom Dick, that's sick for those not from the UK. She was a bit ill, suffering from the after effects of COVID. She said that December inflation is likely to pick up on the base effect, and that inflation is likely to decline more slowly in 2024. Now, she struck a tone really that I was expecting from Powell. She was, again, undovish, saying, you know, job's not done. She said, should we lower our guard? The answer to that was no. Said domestic inflation is hardly budging. Some governors would have liked different tapering earlier or later. That's talking essentially about the PEP. It said we did not discuss rate cuts. She also gave us a science lesson talking about how we move from solids to gases and liquids and whatnot, which was quite funny. So yeah, overall, no cuts from the ECB, no pivot from the ECB just yet. They're still fighting the inflation battle, and that saw the euro on the front foot over that. Obviously, since then, we've had the floodgates open on ECB speakers. ECB's Muller says it's a little early to celebrate victory over inflation. There's still a little bit to go to reach 2% inflation. So the governing council was unanimous on rates, and it's too early to talk about near-term cuts, and we haven't had yet a discussion on cuts. And the market is a bit optimistic if they see first half year cuts. Vilroy, who's been banging on about rates have peaked for months now, said that nobody suggested rate cuts at the last meeting. Now, we have had one of the hawks out, probably the biggest hawk, ECB's Hawky Holtzman. You can probably call this a move to neutral. He says there's a higher probability that we've reached a terminal rate. So he's not throwing in the towel fully. Well, let's say he's thrown in a serviette rather than the towel. So there was no discussions about rate cuts, and the majority at the ECB saw upside risks to inflation. Kay, your thoughts on the sick one?
Yeah. You know what? I'm a bit more hawkish than I expected, really. I've managed to hit both the FOMC and the ECB road this time. So yeah, a bit more hawkish than I expected, because especially coming from Lagarde, who was late when they started to hike rates. Now apparently she wants to be late to start to announce cuts also. But I mean, I wasn't expecting to announce any cuts. I mean, that was out of the question. But the several times she said the fight is not over. She clearly still is of the idea that they can stay higher for longer, and not wanting to make the mistake that they did 2 years ago on the other side. So yeah, a bit more hawkish than expected. But then at the same time, I don't know whether they will also be then more eager to go to the dovish side on one of the next meetings. It almost looked like, okay, this is the last hawkish meeting that we're going to get. She didn't want to give the markets anything to chew on for the end of the year, and then next year we will see. The PEP announcement is, I think some may have seen this as a surprise that they reached an agreement. But we have been talking about that, or I've been talking about that for a while, that it was very possible that in December they reached an agreement. Now, the agreement is reached. That may be adding just one small layer to the hawkish side, but we have to put everything into context. You know, they are going to scale down 7.5 billion euros per month, where the Fed is doing about $90 billion a month, right?
Yeah.
So the scale of it is negligible. Let's put it that way. It's also only going to start in the second half of 2024, and it's a 50 billion euro program. So in 6 months they will be done. So yeah, all in all, definitely more hawkish than the Fed. That is a fact. But it's possibly being be the last one, because if you look at the real data in the back running in the background, or even on the forefront, like those PMIs, like the Bundesbank report this morning revising growth again low. They think inflation will remain sticky, if I read that correctly. But what I did see,
2.7% for 2024
yeah,
from 3.1%, growth 0.4 from 1.2% for next year.
yeah, exactly. And if you look at what the Bundesbank and the German institutes of economic research have been doing over the course of 2023, wasn't anything else but to revise growth lower all the time. And that is still, I reckon, going to be one of the factors as well that we can't forget. These data in the Euroland are not really good, and so that's really. But yes, she was definitely more hawkish than what I thought anyway. Yesterday.
Yeah,
Or at least
and
the two comparable. Let's put it that way.
yeah, and I think that one thing you have to look at is obviously the ECB aren't as high on rates as the Fed or the Bank of England, so there's perhaps not as much urgency to bring rates down because rates aren't as constrictive, let's say, in the Eurozone as they might be felt in the UK and US. So it probably gives them a little bit of wiggle room that she used yesterday on that. Durej asks, who is more hawkish, the BOE or ECB? I'd still say the BOE is probably a bit more hawkish, and can be a bit more hawkish. Now we've seen a pickup in just the PMIs versus what's happened in Europe. Already we were trading up near 110 this morning, and those PMIs have set back the euro dollar now, because the market straight after a hawkish Lagarde looks at the data. Okay, well, the data is still shit, so we take a little bit of hawkishness out of your stuff yesterday. But the BOE, on the other hand, still has higher inflation, still has higher wages, sticky stuff, and has the data to now potentially back it up. But I would say, although that PMI services number in the UK was good, some of the underlying details that went behind that positive number were less positive. For example, some of that activity has jumped because people are getting stuck into old backlogs. Rather than new work, it's completing old work. So you've got to worry, where's the new work coming after they've done that? Also, inflation is rearing its head again. Wages in particular, a problem. Same as in Germany. They're seeing lower activity but higher inflation, and that's definitely not what the Germans want to see. It's the worst case scenario for Germany. Sorry, Kay.
Yeah, no, go ahead. Yeah, I mean, go ahead, finish down. I just wanted to say we also cannot forget that economies like the Eurozone, even though since the pandemic everything has been in an accelerated cycle still, but and let's face it, we're just coming out of it, not necessarily out of the pandemic, but out of the central bank reaction to the pandemic and every subsequent impact that there has been. But we can't forget that traditionally or historically, the Euroland central bank will likely be slower than, for instance, an ECB and or a Fed, because their economics are usually more dynamic than the Eurozone economy, because the Eurozone economy is also a bit more fractioned and more difficult to get together. And And you look at those engines, which are Germany, France, and the core. They're still very slow right now, and perhaps the ECB will be, for that matter, also a bit slower than the other ones. The Bank of England, for instance, you were asking about that. It could actually be more dynamic once everything starts to turn.
Yeah.
Than an ECB, for instance. But in the meantime, having this relatively hawkish Bank of England, and even if we put them on the same footing, um, we can't forget their interest rates are a full percent higher than the ECB as well, right? Not that it
Yeah.
matters so much on a day-to-day basis, because if you have like a 1% move over a day, your interest rate differentials for a year is gone. But it's still zooming somewhere, and if you look at the investors' books, they do look at differentials as well, right?
Yeah, just trying to, if we're entering a cut cycle, they want to try and squeeze out as much yield as they possibly can. So, that could mean a shift into those countries that are going to have a higher rate, even if it's for limited amount of time. It all counts. You may not think it, but a couple of basis points here and there when you're trading billions, all counts to these guys. So,
Absolutely.
and they will shift for a couple of pips. You might not be impressed making 2 pips on a euro dollar trade, but when you're talking billions, small yields or small better yields is a lot of money for these guys.
That's the thing. At equal risk, if you make a 1% on a book, those investors, they have perhaps they have a different approach than we may have, because they're not always looking at the actual effect. They won't be looking at the actual FX moves over the period of what we do intraday or so, but they're going to allocate funds to certain things, and at equal economies, for instance, they will allocate definitely to the higher interest rate.
Yeah, and even when they're not trading, a lot of these firms, they have cash balances, and if you can earn a couple of pips putting it in the pound and you could over the euro, and that money's just sitting in a bank, they'll do that. They'll move it around, and that's part of the reason for FX flows. They will go chasing just that couple of pips better yield, just to get that extra money while it's doing nothing but sit in a bank. But anyway, before we get into the workings of the global financial world, we shall look at some other bits and bobs. I've already lost my train of thought anyway. So let's have a quick look at retail sales yesterday from the US. So the first big bit of data after the Fed. If I can bloody find it. Come on, where are we? Oh, come on, wake up. So altogether, reasonably decent numbers in the retail sales. Better than expected, up 0.3%. Okay, we're not breaking any records here, but the first thing you want to see after an FOMC is how the data is going to react, and the numbers are coming in pretty well. Core sales doing well as well, up 0.4% there. Ex-gas, ex-autos, 0.6%. So power was dovish. Rate cuts are coming, and then the first bit of data says that everything's tickety-boo, which, look, the old bra's back again, which makes... I
made sure to post it in the room.
which makes a bit of the data, I wouldn't say makes a mockery of Powell's tone, but it's not compiling, and that's been the strange thing this week. We've had a pivot from the Fed when you look at the data, and the data's all pretty good. GDP's good, jobs are still good, inflation's a bit sticky, and you think, well, how can you pivot on that data when you've got someone like the Eurozone whose data's far worse, inflation's far lower, and they won't pivot. So it has been a bit of a head scratcher this week, and it has gone against a lot of what I was expecting, and some has gone with what I was expecting. So let's have a quick summary. Where are we with all the central banks? Well, we're talking about the cut race for the last 6 months, whatever. The Fed are now front of the pack. The pivot this week has put them front of the pack. The ECB and the BOE are lagging well behind. Obviously, the Bank of Japan are running their own race somewhere else, sitting on a donkey. Other banks like the RBNZ, the RBA, the BOC, all moving into that neutral, not quite ready to tip to cuts yet, but we were probably at the end of hikes for all of them. So the Fed being in front of the race is going to be a big driver, like they were when they were in the hike seat. It was all about what the Fed was doing. The biggest central bank, or the second biggest central bank to the PBOC in the world, and that influence can overshadow what the others do anyway. And we're seeing a bit of that because obviously the dollar is still getting it in the backside. So that's where we are, I think, in the cut race. The Fed are out in front, and now what we're going to do into the new year is the same as what we've been doing for the last few months, is matching the data off against the market's expectations for the Fed. If we continue to see better and better data from the US, then the market is going to question whether these cuts are going to happen. Now, remember that the market is still pricing some 150 pips of cuts in various assets and markets, and the Fed is only saying we're likely to only get 75 pips. So there's already a bit of disparity between the two calls, and that's what we're going to change. Better data each time from US numbers, that gap is going to close with the market moving towards the Fed. Worse data, then we're going to keep that gap and no doubt increase it, because that's what markets like to do, go to the extremes. So that's how we're going to need to trade it. I think the dollar remains on the back foot for the foreseeable future. Doesn't mean it can't rally or rally significantly, because obviously there's always another side to a currency. So if the Eurozone continues to be crap and data worsens, then you're going to see euro dollar coming down. But that will be from the euro side rather than from the US side. So we're still going to get plenty of movement, but I think the general sentiment for now is that we should probably be a bit bearish on the dollar, and it's going to be in rally sell mode. What's your thinking? Bit of forward thinking, Kay?
Yeah. On the euro specifically?
Anything, mate.
Oh, okay. No, okay. Yeah, I think we're going into. I don't know what the asset managers, money managers, still need to do for the year end, for instance. But I think I was actually very optimistic on risk after the FOMC. I must say that perhaps ECB and BOE took a little bit away from it, but I still don't think it's going to be too bad for risk what we are seeing now. Yeah, the dollar remaining on the back foot, it is supported by what's happening on the yields and on the equity markets front still, right? So I think those two markets will have the influence over FX. We were talking about we were talking about a lot of stuff in our flow room this morning, a bit reflecting on what we did over the year or on some of the moves of the year, and it does seem like FX in a way is getting a bit tired. Yes, we've had those big swings in dollar yen, for instance, and we had a much lower dollar as well after the FOMC, which has not been reversed or not been reversed right now after the ECB and the Bank of England. But I think it's going to be more possibly the equity and the bond market driving us more than FX itself going into the end of this year. That's a bit my feeling right now. We were talking about fatigue in the FX market, and it does seem like some of this fatigue may be starting to come through. Like for instance, the euro dollar yesterday after the ECB, there was a case to make for euro dollar to break 110, right? But it didn't. And then we had the numbers this morning turning it around a little bit. But If you look at the rest of the dollars, they are still very much under the cosh. You look at stuff like Aussie, Kiwi, cable, for instance, even dollar Swiss now with the euro Swiss coming back down. There's some big levels not too far from here in the dollar Swiss, but prior lows have been really we're still hanging around prior lows. So I agree with you on the dollar being on the defensive. But I'm not sure if we're going to have really big moves, and that's somewhere where I am at right now. I'm a little short some euro crosses, and they are supported by both factors. What I think is that the euro less supported than maybe others, and also that risk being a little bit supported. So there's two crosses that I'm in right now, and that's euro Aussie and euro sterling, and those are the main ones. Well, and it's still no big amounts, you know. It's not the time of the year to go press pedals. Really to press the accelerator on a lot of things. And I just wanted to have, if you allow, a little word about the Banxico last night.
Yeah, go mate.
Yeah, so they kept the rate still, and where they follow the Fed to a certain extent, and also hinted last time that they were monitoring data and stuff on the inflation. They did not provide this pivot yesterday, and even though MEX didn't move an awful lot, it does seem like Mexican peso may be one, and I think if risk does okay, and then I'm looking at another pair like dollar rand. If risk does okay, perhaps the MEX could end the year on a positive note, unless risk start to turn around. But could end on a positive note, because after all, it's still an 11% currency, right? I'm not talking about carry, not really, because you're not talking about carry for less than 2 weeks left in a year. But it could just, on the basis of risk, perform a little bit better, perhaps. And that's about my thoughts, really. You know, I'm not sure that we are going to see big moves, but the moves that we have seen may just hold. Let's put it that way. Yeah. And then we wait for the Bank of Japan next Tuesday, but I'm starting to think it's going to be a lot of a nothing burger. But there may be like this odd word here and there, changing the statement again, continuing the preparation for what's to come.
Yeah. Well, the just to let you guys and girls know, we'll only be running the flow show Monday and Tuesday next week, and then packing it up for the holidays. Just to keep you in the loop, because obviously we have the BOJ, which we can talk about in more detail on Monday. Yeah, the other thing to just bear in mind is that we are going to be entering the end of year stuff, so things can get a little funky. So you might be better. This is something I often tend to do this time of year. Take a snapshot of how we close the week, of where pairs are, what's happened, what the levels are right now, and then let the market do its thing. Don't get too sucked into some of the moves you might see next week. If it goes against the trend, if it goes against what we've heard from the central banks and so on, it can get a little funky. So take this week as a reflection of where we're at, and then compare it to where we come into the new year, because we're likely to go back to what we were trading now when we get into the new year. So next week might be a bit funky for stuff. Right, we didn't do much price looking yesterday, so let's have a look today and see what's been going on. Well, we looked at euro dollar, talking about euro dollar. Pretty clear what's going on there. We're still banging ahead up here in the 110s. Haven't managed to get through that yet. So that's our marker for today. Downside, we've got a few intermediate levels, probably down 109, 109.10 is going to be where we need to look for support coming in if we're going to maintain this. But we're looking like overall we're not breaking out anywhere new. you know, we've had this trend down, we've had this move up, we're sticking around in these areas at the moment. So not looking like we're going to be going up there or back down there through 105 or up through 112. So sticking to the ranges for this one, as you can see there. Now, dollar yen, still looking a bit weak. Every rally, it seems, that runs into 142 gets hammered. This one looks like it's walking pretty much in lockstep with what's going on in yields, particularly 10-year yields. So keep an eye on that. What it has done, it stopped crapping the bed. It stopped falling. We're not making new lows. So that's a start. You know my thoughts about trying to catch knives. You want evidence that we've at least stopped falling. However, it's staying pretty tight at the moment in the ranges. So we're not out the woods yet, but you know, if you're going to be getting on those butcher's gloves, then at least you're getting some idea of where the support's coming in. This old line, 141.40s, seems to be showing up. And then you got down into 141 as your last line in the sand. As mentioned, looking at yields, very similar picture. We're not going down anymore. We're finding a bit of support around 390. We're not out the woods yet. So you know where we need to get back above 4% to maybe cement a bottom. So be very careful if you want to catch knives. Keep it tight. Keep your risk small, because if we do go, we're going to go another leg lower probably. One more one I want to highlight just before I hand it over to the K-Man, because I know he's brimming to show you his latest drawings. Dollar China looking like we might be getting a bit of a break on. It's moved back up to 711 right now, but we've had a little move under that data, positive data. They also held their MLF rate unchanged overnight, but they did inject more liquidity into that program than they have, a record amount. But the data, unchanged rates, helping the yuan a bit. Also, there's a lot of what's happened in the US dollar and after the FOMC in this one. But we might be looking at a potential break. And if that happens, then we're going to bring the big 7 level into focus. Although, as you can see, there's a bit of traffic in the way to that one. Kay, do you want to take it?
Yeah, sure, mate.
Let me hand it over. All yours.
Okay, thanks. So a few of those who broke the breaks that were possible have happened. I'm not going to go back onto the euro dollar. Ryan already showed. I said in the room this should be a bit of support in the euro around 109. The immediate support, the first one around 109. 30, 40 perhaps. And for the time being, even after the CPIs, it doesn't look like PMI, sorry. It doesn't look like the euro is really ready to test that support. We will see this afternoon because we have manufacturing and industrial production out of the States, and also some of the PMIs starting to roll in as well. So that may be food for thought for this afternoon on the euro dollar. But one that has broken is the Aussie dollar. You know, I was looking at this trend line and at that 61.8 that we were looking at, and it broke, and it's actually never looked back. I was hoping for at some stage a little bit of a retest, but it doesn't at all. So to close the week, this is bid for as long as it holds at least this 66, let's call it 60-70. But then you will have an extra little bit of trend line support coming in now around 66, 35, 40 on the day. If ever we are getting good data out of the States and we would have a setback in this Aussie dollar, it is probably going to be supported anywhere in this zone now. If I'm right in my assumption, that risk should be doing okay into the end of the year. something like the Aussie dollar could be one of those who is doing well. And that also comes a little bit in conjunction with what Ryan was talking about with the dollar China coming off. Also, we have, and I think it might be from today, that those meat and I think a couple of other products exports to China, those restrictions have been dropped. If I'm right, something was going on the 15th of December, but I'm not 100% sure about the date. But all of that looks to me like supportive for the Aussie dollar. And that could be, I'm not saying it's going to be your play of the end of the year, but I wouldn't be surprised that if the dollar remains under pressure, that this Aussie pushes up into the 68s at one stage before the year is over, for as long as this support zone is now holding. Same could be said on the Kiwi, but I'm much less I'm much less positive on the Kiwi, really. We are breaking above this 62. Before those prior data came out, I was positive on the Kiwi, and also let's not forget it's a 5.5% currency as well. In FX land for the end of the year, it may have its importance, but we have capped this 62, 45, 45, 50 zone. Okay, so this is should be somewhere the resistance right now. So we're within a 50-point range here on the Kiwi. As I said, it has broken the trend line, but I'm less inclined to be long Kiwi. I'm rather a little long on the Aussie Kiwi as well from earlier in the week. It's stabilizing, but I do think there is a possibility that before the year is over, we need another like 3/4 or perhaps 1% to it. Just a possibility, you know, because of the divergence between the data that we have seen of late in both. There's another one that I'm in right now. Yesterday put my nerves to the test a little bit. Is Euro Aussie. That's another one which I'm playing a bit on the positive side of things, the positivity on the Aussie. I'm reluctant to believe much of what Lagarde and friends have been saying because of the data, but I don't want to engage in a short euro dollar really because of the dollar side of things right now. So this is the one that I'm playing rather for as long as it stays below this 164 50-70 zone. If we get a close below 163 figure a quarter of the week, as Ryan rightfully says, take that snapshot. If we close below this week, perhaps next week, as we are going to really enter the end of the year, possibly this may just push a little bit lower. I'm not going to put a rate on it really where I think it may go, but it just could push lower this one. And then
yeah, I've got a question about. I wanted to ask you about dollar MEX. I thought it would be a lot higher. You know, if the carry trade is coming to an end, I thought we might see a bit more of an exit than this one.
I think we've had waves of that prior, and I was just going to come to that because I said something about it in the chat room as well over the course of perhaps the weeks, and so I think we had several. Since September, really, since they announced that that change in their FX programs, right? We had several legs of people getting out of carry trades, and I reckon there has been one more leg that we saw on those big yen drops, but I'm not sure whether there's still a lot of people in it, actually. At least not the short to medium termers. The long termers, I reckon, and I'm just going to pick another chart because I haven't updated it for a while. But if you look at the long term, the longer term makes yen, and I'm talking about the longer term, okay? So if you look at what's happened really since the pandemic, and there you go. If you really think about like long-term carry trades, right? Those people will probably not have entered here because that was it was far too fresh, okay? But they probably have started to start to leg in from here and then pushing on and pushing on, pushing on. Look at what the long term has done, okay? Since the lows, this is the pandemic low, okay? 4.25, we're 8.75, and assuming that they start to enter at 5 or around there, okay, and building up, building up. Look at where the 23.6 is. Even if you look at it from just a simple Fibonacci thing, we're still above the 23.6. So what does a long-termer do here? Does he get out of the position or does he stay in the position? I'd say they will probably still be in the position. They may have lightened up on those moves down. They may have lightened up, but even if you look at the 200 DMA, we are still above. We're hanging above. So if people would look at the 200 DMA, okay, I mean they may say like, okay, if it breaks below the 200 DMA, then I'm going to see where it opens the next day, what we trade the next day, but we're still above. So I'd say that the real long-term carry traders will still, at least for parts, be in this trade. And I would really say that they are still not panicking. That's what I would say on the long-term carry trades. Okay.
Yeah.
I think the medium-term ones, they or the short-term ones, they have been shocked a couple of times. You don't look at a 10 big figures decline in dollar yen and you're not getting panicked, right? But the real long-termers, they're just looking at this one and they say like, well, you know what? I mean, dollar yen, dollar mix has also been coming off over the years, and um, we just continue. Okay, they may have lightened up a little bit on the back of this last move, but I think the real long-termers, they still don't have much to panic about. And they have made, in the meantime, they have made a really big amount of interest rate differential there. They really made a big amount of it. That is for sure. So let me look back then on what I think if those euro data. So the dollar makes, yeah, I was going to say that this could actually start to build a bit of a shampoo if the dollar, the US data underwhelm or so. We could get a move back to 17 or 16.90, you know, just purely on the fact that it's very hard to be short MEX for a longer time still. But the proximity of the dollar makes me a little bit cautious on this one. And this one as well on the Euromex. You see, we had those several spikes of people getting out of those. I would say like the less interesting, but still Euromex. And I've been playing Euromex for quite a while, but I've been very cautious about what's happening here because of all those spikes. But we are starting to hold again. We broke above the trend line, but we stopped at the next hurdle, right? So now we could just be forming a new kind of range or channel around here. So I'm going to see if I get a spike back up here, I'm going to perhaps get interested and see what goes on if it breaks above. But if we start to respect this channel, I'm going to get interested again, just because those European data and because of the Mexico not being really dovish as of yet. Okay, so this is it. Anything else people wanted to look at? Euro sterling, we're back. Euro sterling, we're back. But I also think that there is, besides there's been a bit of discrepancy there on the divergence on the data. We are back. I do think there's a possibility that we are going to get back to 85.5, but I'll be very happy if it gets down there. I sold it once, took it out, sold it again last night around here. We could be in for another move there, but I'll be happy if I see that move. It's not really the time of the year where I'm going to push for stuff, or at least if I decide to stay in something, it's going to be very tiny, perhaps into a year end. But yeah, I mean, I think that the sterling can still do a bit better than the euro, but levels are levels, right? I think you would agree with me, Ryan, there. That, so this is the first level, and then there's your big level, right?
Yeah.
Okay.
Yeah, very much so, mate.
Okay. That's gold. Okay, Mark. Gold. Just going to update it. Right. Gold has been pushing higher through the FOMC, and now this is really becoming a big bottom here, I think, for the gold, big level. But I do think that there's, after what's been said, unless we get like real big surprises on data this afternoon, I think it's going to be relatively rangy unless the data are really poor. So we are on a bit of a level here, okay? The other day I spoke with Ali about it, and to me, I think the next level is just above 2050, okay? I can see this thing starting to range a bit more unless, as I said, the data fall out of bed. If we start to get back below 30, 2022, call it 2020, then there is a chance that we are going back into this low 2000 zone. But therefore, I reckon the data should really overshoot quite a bit for this move to unfold. And again, I think we are, but if you look at this, we could be in this zone again, and then make a decision, you know, whether it's the top side or the bottom side. But I do see it perhaps a bit more rangy right here, Mark and Dereji. But keep those levels in mind. First one, 3032, second one, 2020, and then look at what's going on if we start to move through 2050, okay? I think if you look at this zone, we have been, it's been a traffic zone, okay? And I don't exclude it to be another one of those traffic zones coming up, right? And that's about what's happening here. Silver, constructive, but yeah, it's constructive. Yeah, it is constructive. If we get like okay PMIs without really going like much higher, silver could do better than gold. That is because it's an industrial metal. So if you actually get a decent industrial production or manufacturing production this afternoon, this could actually do a bit better than gold, perhaps. Okay, and that is it for me, Ryan. Back over to you, my friend.
Thank you, mate. That is it for me too. Good old week. Good old week. Lots to learn. I hope you've all had a good week yourselves. If you have, then think about shutting it down, go and enjoy the holidays, get that brain refreshed, because it's going to be another busy one next year. But as always, thank you for coming to the Flow Show and giving us all your wonderful support. Same as Mr. K-Man and Steve and everyone at ForexAnalytix for keeping this show on the road. Have a wonderful day, a wonderful weekend, and we shall see you all Monday. Cheers.
Cheers, everybody.